In this part, I'm introducing the determinants of both pension obligation as a liability and the pension asset. I also introduce what factors could impact both of them. First, the pension obligation. As a liability, it represents the present value of the future cash flows. After an employee retires, the employer has to pay the pension. So the pension represents the future cash flow after the retirement. So the pension obligation is the present value of the estimate retirement payments. And the retired payments is also called annual benefit. So the annual benefits is determined by three factors. One is annual credit. Another one is years of service, salary at retirement date. This is just a general guideline for different employers. The formula may be different. Okay, just give you a simple example. If the annual credit is 3%, which is pretty high, and you work 25 years for the employer, and your salary at the retirement date is $100,000. Okay, so after you retire, you can receive $75,000 from your employer. If you want to receive more, you can delay your retirement by working more years, or you can get promotion before you retired, so you can have greater salary. Or you can maybe argue with the employer for more credit. And the pension obligation name, PBO, which means the projected benefit obligation. The next one is pension asset. To meet the obligation, the employer should set aside some fund, can be managed by either themselves, that's self-administration, or by a trustee. So the self-administration plan is an unfunded plan. That is funded plan. And the pension asset is measured at their fair market value. And because the firm set aside fund, which is cash, will be invested in the capital market, either in the stock market or debt market. So the employer has to report these assets in their balance sheet and the liability in their balance sheet. Some people may also interest in the economic status of the plan. That means whether the obligation is greater or less. So if the obligation is greater, this is underfunded. The other is overfunded. Yeah, I check many firms' 10K form. I find mostly are underfunded because this obligation is a long-term obligation. The employer doesn't have to overfund their pension obligation. Next part is the factors that change the economic status of the plan. First, let's think about what factors can change the pension obligation. or projected benefit obligation. The first is service cost. The service cost is the current value of future benefits earned by the employee. The next is time, because when time passes, liability will generate interest. Third, prior service cost. The prior service cost represents plan amendments grant retrospective benefits. This is usually just one time. And the service cost is every year. 4. Actuarial assumption. Because obligation is a function of employees' lifetime. When calculate the obligation, it relies on the actuarial assumptions. Number 5 is a benefit paid. This represents the benefits paid to the retired employees. This will reduce the obligation. The first 3 will increase the firm's PBO. Actuarial assumption is depends. The next one is the factors affects the fair market value of pension assets. The first one, the assets source is from employer's contribution. The greater contribution, the greater value of the pension assets. There is always a minimum and a maximum of the contribution. Because the contribution for the employer is tax deductible, that means the contribution is a tax benefit. So that's the ceiling of the contribution. To protect the interest of the employee, there is also a minimum amount of contribution. Second, because these assets or cash contributions will be invested in the stock market or other capital market, so the assets will also be affected by the return on the assets. For the actual return, each year we report into 2 parts. One is expected return, which is the fixed amount of return. The next is unexpected. Expected return is always positive. Just like the Standard & Poor's 500 index, in the past 70 years, the average return per year is 7%. Although, during these 70 years, some year may be negative, some year may be a lot of higher than 7%. But we can define an expected return, which is fixed. The difference between actual return and expected return, we use unexpected return to account for it, which is the deviation from the expected return. Okay, for example, if 1 year the actual return is 9%, the expected return is 7%, so unexpected return is 2%. In 1 year, if actual return is negative 1%, again, expected return is still 7%, but unexpected return is negative 8%. Why we do this? Because the accounting treatment for these 2 returns are different. I will talk about this in the next section. The next one is the benefits paid. Same as the PBO, pension obligation. When the benefit is paid, the paid benefits decrease both PBO and asset.